Now let's take a look at the bigger picture. Dale Smothers is with us, President, CEO, RDS Wealth Management. Thank you for being here. So I was reading through your notes and I saw, look, volatility seems to be what's here for 2025. You noted that. You also noted we could even see a pullback. Tell me a little bit about your market outlook.
Yeah, so what we've seen in this last few hours of trading is what I expect 2025 to look like. In one word, volatility, Nicole. You have a lot of headwinds that we're facing with the global outlook, the strengthening dollar. You've got tariffs that are on the horizon. You've got interest rates here at home that are likely to rise to combat what I would consider almost inevitable inflation number that will creep higher and higher. With this, will become more uncertain in the marketplace, and the market does not like uncertainty. For that reason, we will see things all over the place. Even with positive earnings, we could see potential taking of our winnings out of those companies and falling stock prices as a result. We are due for a correction. Historically, we are due for this correction of 10%. And what happens after that correction takes place is really up to where this cash on the sidelines goes. Imagine a world where we have higher interest rates and you can go for, say, 5 or 6% guaranteed in some sort of bond position. It's going to be difficult for someone to take the risk in a risk asset. And if that's the case, if the cash floods to the bond market as opposed to the equity market, we could see a prolonged downturn. Now, I'm not here to call some sort of recession, but I'm telling you that a correction is due, and how the cash on the sideline behaves determines whether we pull out of it quickly or we stay in that downward market trend.
Yeah, and I do want to ask you about some of your strategy for investing in 2025. But first, just the big picture as you talk about inflation and that moving higher. What do you think the Fed should do then or not do?
Nicole, we've said this a time or two on the show, and you and I have had conversations around my philosophy of where the Fed may have missed a mark a few months back or even a few quarters back. That's spilt milk. I know we can't go back to that, but I do believe that inflation has never truly been killed. The inflation analogy that I use is very similar to fighting a wildfire, and we had it down to embers, but the firefighters packed up and moved to the other side of their dual mandate. This was probably a mistake. The lowering of interest rates probably should have never taken place in the first place. With that being said, where we go from now or from here, in my opinion, we have very limited choices. Lowering interest rates is certainly not in on anyone's bingo card, if you will. And higher interest rates is becoming more and more likely if we see CPI and PPI print continue to climb higher.
So it looks like you really have somewhat of a barbell approach because you have defensive picks and then your long-term picks also involve growth stocks or names that have more growth, right? So, or more risk on, let's say. So you think you should have some defensive picks in a portfolio, right? These are some consumer-based names. Tell me about why these names that you listed are important to have.
Right here, when we go looking for defensive stocks, I like to look for value as well. Not only the defensive nature of the stock, but something that maybe is fallen out of favor or it's on a discount. Names that stand out for me right now, Nicole, in that respect are Campbell's. Campbell's right now trading at 15 times forward earnings. We would consider that fairly discounted according to its peers. We're coming off of a nearly 32% high from 2023, from its highs of 2023 till today, down 32%. I think it's not only got potential for strengthening dividend, but also a little bit of capital appreciation as well. Another name that has very similar characteristics is General Mills. General Mills trading at just over 12 times earnings with a 4+% dividend. Couple that maybe with stocks like PepsiCo or McDonald's. You've got really good names that pay a very strong dividend, and they have capital appreciation. Even in a downturn market, that potential is there. The other side of our barbell.
Yes, go ahead.
The other side of that barbell with the long term is NVIDIA, Apple, Amazon. I think we should be snatching up names like that if we have money that needs to work for us in the long term. as we see these pullbacks occur in the market, which I definitely expect to happen over the next 12 months.
So before I get back to the long-term thoughts, I was thinking about some of the defensive plays. You mentioned Campbell Soup, General Mills, Pepsi. You threw McDonald's in there today, and I don't know if you looked at it closely yet, which is fine if you haven't. Conagra Foods is a big one that is a big laggard in the S&P 500 today. It's down 5%. Is that a name that you would look at or want to investigate or add to a portfolio since it's been beaten down? We're going to have a whole segment on it later in the show.
It certainly is. You know, this particular type of, again, barbell approach takes advantage of any of those types of stocks like Conagra Foods that are beat down, out of favor, pay a strong dividend, and are likely to perform well even in a downturned market, especially if it's a prolonged downturn market. Mm-hmm. You know, we can't say that past performance is any indicator of how things will perform in the future. But if we look at some of these names in 2022, when the market was negative almost 20%, some of these names were positive 20+%. And that's a good place to have money working in a downturn market.
And it would be a miss, in your opinion, because your long-term picks have Apple, Amazon, NVIDIA. Those are a lot of the growth names. They are the Mag 7 names. They've had incredible runs. Yes, they're off their highs, but have shown longevity and purpose. And so with that, do you think a portfolio would be missing a name like that? And for example, I was looking at Supermicro being a real winner. Okay, granted, that's a lot more volatile. Today, Supermicro is up 12%, but Supermicro can go one way or the other. Do you look at those kinds of names? Final quick thought?
Yes, ma'am. Most of the clients that we deal with have a need for income immediately. Every single month, we need to generate that income. But we also have 10 years from now goals, and that income has to be there. For 10 year from now money, these types of names that we're mentioning, Apple, Amazon, Microsoft, even NVIDIA at its lows, if we see 10% pullbacks in companies like this, we should be grabbing them at that discount, and we should be holding them for the long term.
So buy on that pullback. Dale Smothers, great to see you, President and CEO of RDS Wealth Management. Thank you.